All right, why don't we get started? So thank you for joining. My name is Mark LaMonica. I look after the individual investor team for Morningstar here in Sydney, Australia. And today we're going to talk about making better investment decisions. So we will spend some time going through PowerPoint with a little bit of background, then we'll leap into our website and I'll show you a couple things you can do on our website that will help out. But first, we have to go through our general advice warning. So anything you hear today is general advice. I don't know anything about you. I can't offer personal advice. If you're over in New Zealand, you can get a copy of our FAP on our website, morningstar.com.au. And also, the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you want personal advice. So, despite all that, ask questions, makes it more exciting. You can ask questions on whatever you would like. And yeah, let's get into it. So we're going to try to make better investment decisions. So a couple things, and this should look familiar to at least the beginning of this to people that were at the conference. I included a little bit of this during our conference a couple weeks ago, but then we'll get into some new stuff on the website as well. So a couple things that are really important. Two things that we're going to talk about today, and two themes that you'll hear over and over today, is number one, looking at structure and structure around your decision making as an investor, and then also self-awareness and understanding what you're trying to achieve, understanding your temperament, understanding your goals, all of that, really making sure that the investments that you do pick are ones that are appropriate for you. And also centered around that, of course, is what is your investing edge. So we'll spend a little bit of time talking about investing edge today. And that, of course, is what you believe is your competitive advantage. What are the things that are going to make you successful as an investor? And an important point before we get into the details is that there are a lot of people that very passionately argue for and advocate for a certain investing technique. So whether that's a value investing or growth investing, or whether that's investing in small companies, so small caps or big caps, whether that's income investing, there are lots of different approaches and strategies you can take with investing. And because, of course, the industry is trying to sell you products, a lot of that advocacy can make investors feel like there's only one way to be a successful investor. And obviously, over time and different market conditions, these different strategies will come in and out of vogue, basically around like how successful they are. But there are lots of different ways to be a successful investor. And if we think about the long term, which is what we should all be thinking about, then even as these styles come, or these different investing strategies come in and out of style, over the long term, just sticking with something is really, really important, and really important to have ultimate success as an investor. So that's kind of what we want to base that decision making around. Okay, what is the approach over the long term that is going to help make you, and we're all different, a successful investor? So don't think that there's only one right or wrong strategy, even one right or wrong strategy based on certain market conditions. Over the long term, there are lots of different ways you can be successful, but find the one that's fit for you. All right, and why is all of this? And we're going to spend just this background information. We're going to talk a little bit about what the issue is. So we have this quote from Ben Graham, and you've probably heard this, and there's a bunch of different quotes. There's a bunch of discussions around the biggest issue with investing is likely the decision making that you are making. And so that decision making primarily, and what we'll look at the next slide, primarily around timing and making poor timing decisions as an investor. And that can be, of course, chasing performance. That can be selling everything when the market's down because you're worried. But it's those timing issues that are most likely going to make a big impact, making those poor decisions, a big impact on the outcomes you achieve. So it is, remember, not the investment strategy, but it's actually that timing. And one of the problems with this notion that there are always different investing approaches to take based on market conditions is chances are once you figure it out, what that strategy is, and you've actually positioned your portfolio for it, it's probably too late. And you were probably making a poor timing decision. So it's important. And what is the impact of this? The impact is returns. So we have a Mind the Gap study that we do every single year. And basically what the Mind the Gap study looks at, and I've talked about it a lot on here, we talked about it on the podcast, what it looks at is the difference between investment returns and investor returns. And you might think intuitively that those are the same thing, but they are not. So how do we measure this? Well, what we're looking at is we're looking at the underlying, let's say a fund, the underlying fund performance. And we can look at that because each night a net asset value and NAV is struck on that fund, and we know exactly what the fund is valued at. So we can look at that performance, but also there are investors that are coming in and out of those funds every day. So it's called flow data. And we can see when people are investing and when they are pulling their money out. And so that's the way that we can look at the two different returns, the investment return, and then the return that the average investor gets. And that return, of course, is influenced by timing decisions. And we can see in the 2021 version of this that investors underperformed investments over a 10-year period by 1.7% a year. So I don't know if that sounds big to you or not, but that is huge. And if we look at that impact over a lifetime, that can be a make it or break it proposition for investors. So let's look at what that impact is. And I was talking about this I presented at this thing called FinFest a couple of weeks ago, that the Equity Mates, a podcasting duo here in Sydney, this investment festival, they put on. And now I can actually show you what the impact is. So this 1.7%, and this was mostly a young crowd. So I did use a very long time horizon, but I think that that's appropriate. So let's say you have $50,000 and that you're investing for 40 years. So you're a 25-year-old and you're investing for 40 years. You're not even adding anything to this. So you're lucky enough to have $50,000 to invest. So remember, so 1.7% difference. So let's say 8%. So you get an 8% return on that $50,000 for 40 years. And there you go. You get a little over $1 million. Now, let's say you're the average investor and with your $50,000, you're chasing performance and you're going in and out of different funds and ETFs and investment styles based on what you think will work in the market. And you get that gap, right? So all of a sudden you get 6.3% a year. Well, look at that. So you only have $575,000. So that's an enormous difference, right? And that's without even adding any money. You're not even saving money. If I put in even modest additional savings, that gap is going to seem even bigger. It's going to be bigger. So this is pretty huge. So remember, and I always think about this before I make any single trade, I always think about, okay, this gap, what am I doing? Why am I doing this? Because there's also studies that come out, and there's a pretty famous study that came out of UC Berkeley that looked at investors and it looked at what they sold. So it was taking brokerage account data, and I was looking at what they sold and what they purchased. So in cases where investors were switching investments, and the thing that they purchased underperformed the thing that they sold by a pretty, and obviously they're aggregating the numbers here, but by a pretty meaningful amount when you start looking out over a couple year period. So once again, just remember those timing decisions and then remember the impact of those timing decisions because they can be pretty profound. So how are we going to try to prevent these timing decisions and making poor decisions? Well, this is where we want to start thinking about our edge and our strategy. Now, edge is a sort of finance jargony term that refers to the advantages that each of us possess and each of us can bring to the table as an investor. And there are really four sources of edge. And, I'll talk about this long-term orientation thing in a second, because that's something we can all have, but there are really four different sources of edge. So there is informational edge. So basically informational edge means that you have access to information that other people don't. Now, in the age of the internet, And in the regulatory rules that we have right now, it's basically impossible to have informational edge. Very, very difficult. If you do have informational edge, you potentially are breaking the law. It's insider trading, but informational edge used to be a big thing, right? Before sort of this ability to disseminate data globally instantly, like informational edge used to be a big thing. Kind of technology and regulations have really gotten rid of that. So you probably don't have informational edge. The next piece of edge that you can have is analytical edge. So analytical edge means that you have the same data and same information as everyone else, but you are able to make a better decision off of that. So you're able to use that same information and come up with a better conclusion about a attractive investment. So maybe you have analytical edge. It's certainly a possibility. This is why we have analysts, that what they're trying to do is, of course, exploit their analytical edge, at Morningstar's case, but anywhere, right? That's why we have active management. That's all trying to exploit kind of analytical edge. And maybe you have it, maybe you don't. Personally, when I look at myself, it's not something that I believe I have. But that's really why we want to go in there. And that's why many investors think sort of the secret to successful investing is to go in there and analyze those different investments. But if you do think that you have analytical edge, I would just be somewhat skeptical of that, just because it is a very difficult thing to do. And I think the thing that a lot of people, what kind of passes for analytical edge, is sort of this first order thinking that a lot of people have. And a lot of that is around themes and thematics, right? So you're taking something very obvious, right? Like, oh, climate change and spending to prevent or slow climate change is going to be a huge theme. So I'll just invest in all these climate change related shares. Just be careful with that stuff, because kind of that first order thinking where we're taking something that everyone believes and then thinking that we're going to be able to find investment opportunities off of that is very, very difficult. So just be careful about analytical edge. But then the next two pieces of edge, all individual investors can have. And the first one is behavioral edge. And that's sort of what we're talking about today. How do you make better investment decisions? Because that's something that any of us can have, right? And a lot of that behavioral edge is recognizing the biases that we have as investors and recognizing things like timing mistakes, things like overtrading is probably a bad idea. Chasing performance isn't a great idea. Sort of recognizing all of that and putting structure around your investment decision-making to try to reduce the irrationality that goes into investing. We know that sort of this quest to be perfectly rational is not something that's possible, but at the same time, you can cut down on it. You can cut down on it through structure. And that's what we always advocate here, right? That's why we talk so much about goals, setting yourself up to achieve goals. So behavioral edge is a big one that we can have as individual investors. And then the last piece of edge is called structural edge. And what structural edge refers to is basically that there's a lot of structural impediments to good investment decision making. And a lot of that is on professionals, right? And a lot of that is on professionals because this is their job and they don't want to lose their jobs. So what do you do then? Well, you exhibit a lot of herding behavior, right? If you don't want to lose your job, if you don't want to sit there in your review at the end of the year with your manager and talk through talk through basically, if you're a portfolio manager, talk through the investment decisions you've made, it's a little easier to sit there and do what everyone else does, right? And that's why you see this herding mentality. You also see a lot of very short-term mentality. And, everyone talks about how they're long-term investors, but if we go and explore actual fund data, people are not. Professional investors are not. So structural edge as an individual investor is just the fact that none of this applies to you, right? So this is not your job. You're not going to worry about losing your job. You're not worried about your compensation. You're not trying to follow what everyone else is doing, or you don't have to do any of that, which means you can truly take that long-term orientation if, once again, you align your goals with your sources of edge, with your investment strategy and the plans and that framework around your decision making. All right. So a couple things to think about when we're talking about, and this is how to find a share, but it's also how to find anything else that an ETF, a fund, et cetera, whichever way you choose to invest. But one of the things to think about when we're trying to find investments that align with our goals and our temperament and our sources of edge is thinking about, okay, what are the things that are likely going to induce me to make poor decisions? And for investors in general, a lot of it is volatility. So it's how much, and this is why it's a challenging time for investors right now, because we've seen market falls, we've seen everything fall, right? We've seen bonds fall, we've seen shares fall. So one of the big things that comes out of this Morningstar Mind the Gap study is that as volatility increases, basically as the market goes down, this gap actually gets bigger. So investors are making worse decisions when, of course, there's times of stress, and a lot of that makes sense. So thinking about how you are going to respond to that volatility, how are you going to respond to that, is thinking about business risk and realizing that the range of possible outcomes differs by company, differs by investment style. So it's something you can think about, okay, how is my temperament going to fit into situations where I am stressed as an investor? So what kind of investments actually match that temperament? All right, so a couple things that we should know. When we are investing, of course, we are thinking about the future, but based on the type of business that we are purchasing, and that's what we're doing as investors, right? The range of possible outcomes is going to differ. And the simple example I always use, and I know I'm a little bit of a broken record, but I think people intuitively get it, is that, if I'm trying to figure out what Coca-Cola is going to do next year or in 5 years, right? And that's what I care about as an investor, trying to think about those future outcomes because it's going to influence the share price. When I start thinking about that, the range of outcomes is pretty small. Now, range of outcomes for a brand new company that is a biotech company, right, that's trying to get a drug approved in order to go to market with it, the range of outcomes are really big, right? They could have some blockbuster drug that causes some giant pharmaceutical company to buy them, for example. Well, that's a great outcome, right? And that's something that would really benefit shareholders. Conversely, maybe the drug doesn't get approved. Maybe it doesn't work. Maybe there's a better drug. All this stuff that we don't know, is it's still being developed? Well, that means the company can potentially go out of business. So those are bigger ranges of outcomes. So the likelihood of more volatility just because of that business risk is something we need to account for. And then the second point right now is thinking about expectations and thinking about the expectations that are baked into any investment you are making. So, a really good example is let's use Tesla as an example. And so everyone talks about, obviously, the future of electric vehicles and all the advantages that Tesla has over a lot of their competitors. And all of those are true, but those are all baked into that share price. So what we're looking here is at a valuation level, what are we paying? So Tesla is trading at something like 350 times earnings at the beginning of this year, right? That's never going to be maintained. And everyone knows that's never going to be maintained. Everyone knows that valuation level is going to come down over time. It has to, right? 10 years from now, Tesla's not going to be trading at 350 times earnings. But of course, people are looking at that growth saying, okay, the growth makes up for it, right? So even if this thing is trading for 20 times earnings, it's going to grow those earnings so fast. And it just started making money. It's going to grow those earnings so fast that the share price is still going to be up, even with all of that happening. But just think about all of that is baked into that share price. It's baked into that valuation, and all those expectations are baked in. That's why price is really important. Price is representing, and the price we pay for something as an investor is representing those future expectations. And it's price, when we're talking about that, is really valuation. So trading at X times earnings, for example. So just something to think about, that stuff is baked in. All right, so let's go and use an example now. We're going to go back to the website if I have not put everyone to sleep. All right, so what we're going to do is we're going to talk about a little bit about that structure. And what we talk about a lot on here is goals. So it's obviously really important to define your goal first. And so, you have the ability, and I'm not going to go through this because we've gone through this process so many times on different webinars, that people are looking for a goal webinar, email me and I'll send that to you. But yeah, we've got all these goals. We set up our goals and we understand where we're trying to go. So the next thing we want to do as an investor, and this is where we're going to spend our time, we're going to talk about creating an investment policy statement and what goes into that, because it's some of the stuff that kind of theoretically we've been talking about so far. So I'm going to create an IPS, and you can do that. This is obviously the tool that we're using at Morningstar, but you can do this on a piece of paper, right? Creating an investment policy statement and creating a strategy to put structure around your decision making is the key here, right? Not what tool you use. So we need a name. So why don't we call this? I don't know. Think of, what do you think? Emily gets very upset when I ask her stuff. Oh, she's happy. She changed her hair a little bit, and I noticed today. So she was happy about that. We'll call this Emily wants to leave Morningstar. That is her goal right now. So we'll put that in as a goal. We'll call it retirement. So you don't want to leave and go somewhere else. You just want to stop working. She's shaking her head. Yes. So what that allows us to do, or what this tool allows us to do, is, okay, I've already set that one up. Oh, sorry. So this is aligned to the goal. So this portfolio is designed to generate income prior to reaching preservation age. Here's the investment policy statement. And once again, you can do this just on a piece of paper. So what we want to do is we want to outline the strategy that we're going to use. And we want to keep all of this in mind, everything that I was talking about, the types of investments that we want to use. We want to keep in mind the types of investments that fit our particular temperament, and we can add a strategy. So I'll document one for you, Emily, even though this is your goal. She's happy about that. If I brought her out here, she'd be very upset. So Emily has decided, much like me, Emily has decided that, she's going to focus on lower business risk companies because, she doesn't want to see all that volatility that's going to result from those wide ranges of business outcomes. And she also thinks, okay, well, I don't really want to invest in companies that have this huge expectation already baked in, right? So she's going to be very focused on valuation as well. So she can document that in this strategy. So what is her approach? She's going to find low business risk companies that are trading for a reasonable, sort of testing my spelling ability, valuation, because the goal is to limit volatility in the equity portion of my portfolio. All right, well, that kind of makes sense, right? So at least she is now kind of sitting there. And why is she doing this? Well, she's doing this because, number one, that sort of fits her temperament and fits the approach she wants to take. She's already got her goals locked in, right? So she knows how much she needs to, knows how much she needs to get from a return perspective. She knows that she's designing a portfolio to generate income prior to reaching her preservation age, right? So she wants this portfolio to generate income, all right? So low business risk companies that pay dividends at a rate higher than average. They're trading for a reasonable valuation. Now, what's her edge? So she doesn't think she has informational edge. So she's not going to go out there and, insider trade. She doesn't think she has analytical edge because she doesn't want to spend all her time going in there and trying to analyze companies. But what she does think is that she's got behavioral edge. So the first thing she's going to do is she's going to make this into behavioral. And now I spelled something wrong. How embarrassing. Oh, well, that's not right. So this is using US spelling. Interesting. So she's behavioral edge, which means that she's going to have a lot of discipline around her buy and sell decisions. Which means she's basically going to be a buy and hold investor. So what does that equal for her? Buy and hold. So she's going to hold things over the very long term, which also go into the structural edge that she has, and that is being a long-term investor. Okay, so now she's starting to define a little bit of a plan. She's got asset allocation. We're not going to spend a lot of time on asset allocation today, but she does want to go in there and set her asset allocation because this is hooked up to a portfolio. It's actually showing you where the portfolio is invested. I set this test portfolio that's hooked up with this, but what she can go through and just define her asset allocation. So she's going to do a lot in equities, right? 40% Aussie, 40% there, and maybe she'll keep 10% in cash, and maybe we'll put 10% into listed property, whatever. The point is not asset allocation, but she wants to make sure that that asset allocation is going to reflect what her goal with the return that's needed to achieve her goal. So once again, if that return is a little bit higher, then she's going to want to make sure that she's tilting that portfolio into growth assets. All right. And then she can actually go through and define her criteria. So this is where she's going to start to look at, okay, I've got kind of this strategy. I understand my sources of edge. So the strategy is reflecting both the goals I want to achieve, and it's reflecting kind of her investment style. Then we've got our sources of edge. How is this going to translate into this investing criteria? And so she's going to start to look at, okay, so what are the actual instruments I'm going to use to get this to achieve this goal? And so what it might be is very simply in this case. So what is she looking for? Well, she's looking for sort of quality companies at the end of the day. That's kind of what her tilt is. So it's towards quality and it's towards income. So she might just sit there and look at, okay, she's going to look for ETFs because she doesn't necessarily want to go out there and buy individual shares. She's going to look at ETFs that have a focus on quality and income. So what does quality mean when we talk about quality? Well, it's really looking at sort of lower business risk companies. So it's going to start to look at companies where there isn't a lot of variation in earnings. So if you go and look at some of these ETFs that do have this sort of quality tilt to them, a lot of the criteria they're going to use is they're going to look for companies that have earnings that don't bounce around a lot. To put that very scientifically, that don't bounce around. We'll say that. Earnings that don't bounce around. So what does that mean? We're going to start to eliminate some of those cyclical companies, right? Companies that are going to vary a lot as the economic cycle varies. So a good example in Australia, right, is a lot of commodity producers. And for those that tuned into our webinar yesterday, our analyst John was talking about copper, and talking about how copper is something which price varies a lot based on people's projection of the economic cycle. So, that's an example of, hey, maybe these commodity producers are not what Emily wants to put in her portfolio because they are very cyclical. So she's going to look for non-cyclical companies. So she's probably going to look for companies maybe in the consumer defensive category, companies in healthcare, and a lot of those are going to score higher on those quality measures because you don't have that variation of earnings. So earnings that don't bounce around. She's going to look at companies with low debt. We can even see reasonable debt, but still companies that are in the lower end of the debt cycle. Because once again, remember, taking on debt, whether you're a person or a company, that adds risk, right? So those are companies that, of course, could be running into trouble now that we're seeing interest rates going up. So, of course, that's not a great thing if you have a lot of variable debt and you're paying a lot more now to support that debt. So low debt and also any sort of crisis that happens, right? Having low debt is certainly a good attribute as a company. So earnings don't bounce around, low debt. She wants high dividends. Now, dividends are not necessarily an indicator of quality. But if we're looking at higher dividends over the long term, what that's going to tell you, it's going to tell you a couple of things about the company. Well, it's going to tell you it's probably a pretty mature company, right? It's going to tell you that that company is actually making money and that there's cash coming in the door that can support that dividend. So there are a couple of triggers that that dividends are going to tell you about. What you're probably looking for is you're probably looking for companies that have sustainable competitive advantages, right? So if she wants to invest in this company over the long term, right? Because remember, she's got these very long holding periods, which is what she's looking for. We're probably looking for companies with moats. Now, why is that? Well, a sustainable competitive advantage for a company, of course, represents or is reflected in the fact that that company is going to do two things, which are important. One, it's going to earn extra margin, right? So the margin between and the difference between what it sells a product or good or service for, and then what it actually gets to keep. So the revenue versus the earnings is going to be higher. It's going to be higher because it's got that sustainable competitive advantage to keep those competitors at bay. So it doesn't have to compete as much by lowering prices and by investing a lot and trying to create a better product. So that's one part of moats. The other part of moats, so she's going to look for high margins. The other part is return on invested capital. Now, return on invested capital just looks at how efficiently management is investing or how efficiently the company is investing in itself for growth, right? The return that it is earning on investments it makes to growth. So once again, if you do have a sustainable competitive advantage, if you're keeping those competitors at bay, you are able to earn higher returns on what you invest in the company. So she's going to look for moats. So, all right, those are her criteria. So what she can do now, because she's looking at ETFs, she can go and find ETFs that actually reflect that, and she can look at the portfolio. Now, one simple way for her to do is look at a dividend ETF or look at an ETF with a quality bent, right? That's going in there automatically and looking for some of these attributes. So that at least gets her started. What this is going to prevent her from doing is it's going to prevent her from perhaps chasing performance and jumping on the bandwagon of every new thing that comes out, right? We're seeing a lot of this with ETFs, right? Where we have all these thematic ETFs that come out that are really supposed to give investors exposure to a theme that's widely known, a theme that probably is already priced into that into those companies that it's holding. So the valuation levels are going to be higher. So she's going to avoid all of that. And she's going to avoid that when people come up to her and say, hey, there's this awesome new ETF that Beta Shares came out with that tracks, God knows what. She's going to be able to say, okay, well, that doesn't fit the investing criteria that I have. And my investing criteria is based off of my edge. It's based off of my strategy. So why'd you write all this stuff down? And then, of course, there's rebalancing. So she should look for rebalancing opportunities. But why do you write all this stuff down? You write all this stuff down because you want structure around that goal. And that is going to be the thing that prevents you from just going out there. And I can hit next and save this thing. Okay, so now I've got everything on one page, right? But this is what you can do anywhere. Obviously, we like people that use Morningstar, but this is something that you can do everywhere. Now we've got everything on one page. So she wants to retire early. She wants to do that by generating income that she's going to be able to collect prior to reaching her preservation age, which is a long time for you, Emily. Emily's got a ways to go for retirement. She knows, okay, how much she needs. She knows her rate of return. She knows her time horizon. She knows when it ends. And now she's got target asset allocation. She's got her strategy. And what this allows her to do is save this, which means anytime somebody comes up to her and offers her, as I said before, one of these new investment opportunities, anytime she gets tempted, anytime she is at a party and one of her friends tells this Bitcoin investment that they made and how much money they've made off of this, and she starts feeling some of that fear of missing out, what's she going to do? She's going to go home from that party. Sounds like an exciting night, Emily. She's going to go home from that party, and she's going to look at her investment policy statement. And even though she wants to, I don't know, go to Europe off of her Bitcoin earnings like her mate, she's going to go back and say, no, I'm actually investing for something different. I'm just going to go to Europe a lot when I'm 65. How does that sound, Emily? That's the opposite of FOMO. And there you go. There she has it. Emily wants to leave Morningstar. That is her goal. She can go in and look at her portfolio if she wants as well. See if everything in her portfolio is aligned with her goal. She can, go look at the goals that are aligned to the portfolio. Oh, she's got her goal. She can go back and revisit her goal. Here she is. She wants to retire early. She's not saving anything. She just wants to have $4.5 million so that she can go to Europe. Emily just got back from Europe, by the way. I don't know if she spent $4.5 million. It's none of my business. Then she go look at her portfolio. So that's really what we're talking about in terms of the structure that we want to put into any investment decisions that we're making. And there's all types of, and once again, been over this a couple of times, but there's all types of biases. There's all types of external pressures that are making us act irrationally when it comes to investments. All the stress that's happening with the constant data and market movements, and all of this is adding irrationality into it. It's causing that gap between what we're earning as investors and what the underlying investments are earning. And it's causing us basically to make these mistakes and make these poor decisions, which are leading to poor investment outcomes. All right. Well, people must have been very excited by this one because we had a grand total of 0 questions and comments, which is good. So maybe we'll strike this one off the list next time. What do you think? Emily's looking at me like I'm crazy. But anyway, thank you guys very much for joining. I appreciate it. If you have any questions, you can, of course, email me at mark.lamonica1@morningstar.com. Oh, we've got a keep it. All right. 2 votes. There we go. Okay. Anyway, thank you guys a lot. And I'll be back on Thursday. And if Emily doesn't call in sick, she'll be sitting in the room. So thank you guys.